everyone, and welcome back to another video. This is Alex Muir, helping millennial professionals reach peak mental and physical performance. And in today's episode 4, is going to be on mortgages, my financial ed series. Now, in this episode, I'm going to be talking about my top 3 tips surrounding mortgages, which brings me to my first tip. Tip number 1, find yourself a great mortgage advisor. Now, finding yourself a great mortgage advisor is going to be probably the most important step of this process. Getting a great rate is another important step, but I'd say the most important step is finding yourself a professional that has done this for a while and can help you along your process of entering the market. Now I'm going to be talking about this video from a first-time homebuyer's point of view, getting into the market to get your mortgage, and because I'm actually, I currently own my own home and have so for the last 4 years, so I want to tell you guys kind of that process that I went through. To give you some tips. First of all, if you can apply through the bank, you get a mortgage through the bank, it's going to be much easier to kind of stick with the bank and get those rates for staying with them. You can get some better rates sometimes, but if you're looking for more flexibility and your debt load's a little bit higher than you anticipated, and you do have the savings but your debt load's higher, look for a mortgage broker. So you've got banks and mortgage brokers. I went through a mortgage broker and I've never looked back. And they made things work for me when things, weren't perfect. So keep those things in mind. If your financial situation is good credit, good income, good repayment history. And tip number 2 is shop around for a great rate. Now, with having your own mortgage advisor, they're going to help you do this, whether that be from the bank or a mortgage broker. Right now in Canada, we've been in a lower interest rate market for a number of years, and it's kind of stayed the same. It's just the way things are today. Mortgage rates have increased a little bit from time to time, but we haven't really seen a spike. So borrowing costs are low and mortgage rates are low. So people have a lot more buying power because they're borrowing more money. When you're applying for a mortgage, you got to keep in mind also of a fixed rate of interest and a variable rate. Now, it can work either way. I've known people when I was working at the bank that have had a variable rate mortgage for the last 20 years, and all the rates have done is gone nothing but go down. So that is a more risk-friendly version. I'm very conservative. That's why I went with a 5-year fixed rate mortgage. But you got to figure out what's right for you. Talk to your mortgage advisor from the bank or your mortgage broker and see what solution is best for you. If you're someone that's either single or in a relationship, you're most likely going to want to go with a fixed rate mortgage, because then you don't have to. Then your payments are going to be the same for that duration of time, versus going with a variable rate mortgage. The rates could go up or down, and if you're someone that's more conservative like myself, you want to have that peace of mind, knowing that you're paying the same thing every month for the next few years, and then you can reevaluate your financial situation later on. Which brings me to my last tip. Tip number 3 is utilize your savings or investments for your down payment. Now, when I'm talking about savings or investments, this could include your down payment that you've saved in your registered retirement savings plan, your tax-free savings account, stock, index funds, or mutual funds. Or it could be that you were gifted part of the funds from a family member. So there's a variety of ways you can do it. If you can avoid it, try not to borrow money as a down payment. It will because what the banks or the mortgage brokers do is they take into account all of your debt load. Even if you're using, let's say, a line of credit or a loan as a down payment towards your condo or your house, they still take that into account to your debt to service ratios. So if your debt load's too high and your income and credit is really, really good, they're still not going to approve the mortgage, because all 3 of those things need to be in line. Debt is low or minimal. Credit score is excellent or good, and level of income is very strong. So, and repayment history. It's like a pie chart of what the bank looks at. So, hope you guys will enjoy those tips. Again, this is episode 4 on mortgages for Canadian Millennial Professionals. If you like this video, hit the like button, comment, rate, and subscribe. Take care.